Hi, everybody. Welcome to webinar number 7 in our series of FX trading fundamentals for BK Forex, how to trade news. As always, trading foreign exchange on margin carries a high level of risk, may not be suitable for all investors. I ask you to read this disclaimer very carefully to understand all the risks of trading in margin and to seek advice from an independent financial advisor if you have any doubts. So let's review a little bit about what we've done so far. We started out with an easy guide to understanding the global economy. Then we went on to the fundamentals that matter, isolating the absolutely key economic data points that have the highest probability of moving the market. Then we talked about how to predict the economic data. And what's going to be interesting today is we're going to tie these two lessons into some practical applications of this lesson today. So watch this very carefully, and we'll see how the data that we learned over here and over here is going to be very applicable to over here. Then we moved on to peek over our shoulders, which gave us a view of all the key instruments and tools that we need in order to be able to trade FX effectively. And then we looked at each individual currency pairs amongst the majors, the euro, the pound, the dollar, the yen, the Aussie, the Kiwi, the CAD, and the Swiss, and try to isolate the key personality differences and the key value sets that differentiated all these currencies between each other. And then, of course, today we're going to try to put a lot of this theory to practice and share with you some of the ways that we can trade all of this news, trade all this information in an effective and efficient manner. So let's begin. Trading the news. Why is economic data so important? That seems like an obvious question, but a lot of people actually don't appreciate it because really, economic data is one of the absolute critical factors that moves the market. I always say there's really only 3 things that move the market. Economic data, which is scheduled and anticipated and surprises the market because, for example, it's different from what is forecast. A motivated buyer or seller who is not motivated by macroeconomic concerns but by personal concerns. So a very large corporate that wants to buy €1 billion because they need to meet payroll, or merger and acquisition activity, or a hedge fund that's putting on a position that is a year-long position, but it's a very large position. They can move the markets. And the third thing that can move the markets is unexpected news, right? So really, there's only 3 things that pretty much move everything around. Everything else around it is just lots and lots of people reacting to that movement that is happening by the 3 factors. So one of these 3 factors is, of course, economic data, and that is why it's so incredibly critical to be able to understand the markets. News moves currencies and equities. That's without delay. And of course, we're going to see a very prime example of that just in a little bit with the ECB press conference. But we're also going to see, of course, a good example of this tomorrow when we're going to trade live the NFPs. So those of you who haven't signed up, feel free to sign up. Go on my Twitter feed to get the link, and we will show you some of the ways that we're going to trade. So today, though, however, we're going to discuss 4 ways to trade the news. One of them is proactively, and 3 of them are varieties of reactive news trading. And I think this is fascinating because we're going to highlight the better, and we're going to highlight basically the positives and the negatives, the risks and the rewards of following each method, and let you guys choose what you think is best for you. Feel free to ask me, by the way, questions on each one of these methods and explore its pluses and minuses, because they're very, very different, and they, I think, require a very different mindset if you want to engage in one versus the other. So let's understand proactive trading, which is very interesting, but also can be very perilous. What is proactive trading all about? Proactive trading is the ability to anticipate the game, right? The best example I can give you is if you ever watch a tennis match, and you watch a tennis match at Wimbledon or US Open amongst the top players, like if you watch Nadal play, or you watch Federer play, or you watch Andy Murray play, what you see amongst the top tennis players is that they don't stand around waiting for the ball or waiting to react to the ball, right? You're always seeing a tennis player moving towards a spot that he anticipates the ball to be at. They're always anticipating. This, by the way, results quite frequently in them being wrong and something called flat-footed. Many of you have probably seen this in tennis, where a tennis player moves to the right, and then the ball is hit behind him to the left, right? And instead of being upset about it and looking foolish, they just accept it as part of the game. This is the trade-off of anticipating the move. You cannot get to the ball unless you begin to run ahead of time, just like you really can't benefit from a big move in news unless you anticipate it ahead of time. But the result of it is that when you're wrong and you're going to be moving one way, the ball is going to go the other way. You're going to get flat-footed. It's just the nature of the game, and that is the essence of proactive trading. The benefits of it is, of course, you do have lower, but by no means low risk. Lower risk in the sense that you're isolating the event just as it's happening. In other words, you're not in the market, you're in the market for a very short period of time. You're not subject yourself to other market forces. You're basically focusing on the event itself as the primary force that you're going to trade. So in that sense, you lower your risk, but by no means have a low risk. It's instant gratification. It's very fast. You know, there's 24 hours of trading in the market, and there's about 5 to 10 minutes on a news event. So you're spending 1/10 to 1% of your time, and if you're successful, that's all you really need to do to capture the pippage that you need for the day. And it's also very clean. Basically, it's a very binary trade. You either win or lose. There isn't sticking around watching it bleed one way or the other, or watching the screen for hours on end. But the disadvantages of it, number one, is it's very, very difficult. I mean, if this was easy, everybody would be able to front run the news. And if it was easy to win the Wimbledon, everybody would become a tennis player, right? It's extremely difficult to anticipate something effectively, efficiently, and accurately. So one of the key things that you want to do is that you really want to make sure that when you're going to be trading the news proactively, you want to focus on what we call Tier 1 versus Tier 2 data. You want to focus on pure event risk. And what that means is you don't want to trade something where there is tremendous amount of volatility or there is really no expectations, right? So non-farm payrolls and central bank rate decisions, when they come out, even if there's a minor discrepancy one way or the other, the volatility is so huge, it can be as much as 100 points, that the risk of assuming a position in front of those events is significant. Anything without a forecast makes it almost impossible to try to gauge intelligently what the event is. So you avoid all those events. At the same time, you need to be able to trade events that have meaningful movements when they impact the market, but not so meaningful that they can destroy you for 100, 200 points. And that is what we call Tier 1 data, and that's basically events that we would consider to be like retail sales in UK, retail sales in Australia, CPI and PPI numbers in Australia, in UK, maybe in New Zealand, employment data outside of the US. The US number is just so volatile that it's very, very hard to trade proactively. And of course, you'll see us tomorrow trading it reactively, which is something we're going to get to in a minute. But employment data in other countries like Australia, UK is okay to trade, and it tends to have a big movement. One other event risk that I would add to this list would be GDP. We saw, for example, very good example of it this week, where we traded the Australian GDP, and it had a big, meaningful move on the Australian market because it missed. So UK GDP, Australian GDP, even US GDP, which we have today, I think, could be a meaningful market mover and enough to want to handicap the move. So lastly, by the way, we certainly want to avoid data from Japan and Switzerland because neither one of those data sets has any impact on the market. And we've talked about that in our coverage of the currencies, about the yen and the Swissy, and how they trade on completely different dynamics than the economic data of their countries. So let's take a look at a couple of examples. And here's a GDP example that I was just talking about of how we could possibly trade something proactively. German GDP comes out 2 o'clock in the morning, 7 o'clock GMT, 2 o'clock East Coast time. Expectation is minus 0.5%. The previous was around 0.2. And we're going to make a call saying that we think that the number could disappoint? Could it be weaker than expected, right? What we're trying to do here is, we're training proactively, is not forecast the actual number. We don't have to forecast the actual number, and we're really not trying to be that precise. What we're just trying to figure out is, what's the probability that it's going to miss or beat expectations? Because that's really where the trade is at. It's not the number, it's not the absolute number itself, it's the number relative to expectations that moves the market, right? So we're trying to gauge the relative to expectation number to see how well it's trading. So let's take a look at why we think the GDP number is going to be weaker. We know that the GDP is made up of consumer, investment, government, and net exports, right? The consumer is really a function of retail sales. How much the consumers spend is going to be reflected in retail sales. And trade is a big component of net exports, right? So one of the things we know when we're looking at the German GDP is that retail sales were very, very weak, and a German trade balance was weaker than expected, right? Both components that go into the computation of the GDP. So if these two components, basically two of the three variables or four variables or factors, were weaker than expected, the probability that the absolute number, the gross number, is going to be weaker than expected is relatively high. And so we make an intelligent guess, effectively. We make a educated guess that German GDP may miss expectations. Now, expectations were 0.5, right? So we enter our position no longer than 20 minutes before major news release. And I actually, believe that we should enter the position 5 minutes before the news release, just to eliminate any of the pre-news release jitters in the price level. So we're coming in 5 minutes before the release, short euro dollar, because we think it's going to be negative. And we're going to place a stop at 25 pips. Now remember, the single greatest danger of proactive trading is that if you're wrong, the stop is blown. And even though you may have a 25 pip stop, you could have an actual stop of 50, even 75, maybe even in the worst case scenario, 100 pips off if the market just simply completely moves off the direction. But because we're trying to avoid the non-farm payrolls, the ECBs, the probability of such a vastly bad move against you, relatively small. Not impossible, but relatively small. It's the same kind of a thing as jaywalking in New York City, right? So if it's 4 o'clock in the morning and I'm standing on Broadway and there's very light traffic, the probability of me getting hit by a car as I'm jaywalking Broadway, very, very small, right? If I am doing the exact same thing at 4 o'clock in the afternoon when the traffic is very heavy and everybody's coming in from for rush hour, the probability of me getting hit by a car is much higher, right? So it's the same kind of a thing. We're basically trying to cross Broadway at 4 a.m. in the morning when the probability of us getting hit, blindsided by something bad is relatively small by eliminating the really, really high volatility events. So we place a stop at minus 25, right? We get short here, right, around 34, 36. And the actual number comes out minus 6. We were correct. We were correct, and that helps move prices down, right? And you actually see the euro start to this is a 2 o'clock chart, right? And the euro starts to really tumble down. And there's a couple of ways that you can trade this event. You could basically say, okay, I'm going to do 1 and 1, which means that I'm going to get short, 20-point target, 25-point stop, and just take all my money if the target hits, get out if my stop hits, and that's it, which is okay. Another way of trading, which allows you to enter into a position and then milk it for all it's worth, is by doing what we call a half and half. The idea is that basically you cover half your position when the amount of risk is covered. So if you risk 25 pips, your first target is 25 pips. Once you make 25 pips, you go to break even, right? Now you've covered half your position. And then you can trail your stop by a couple of various methods. you could basically say, okay, my second position, I want to make 3 times my risk. So I know that's going to be a very rare event, but on the times that I do make it, it's going to be a huge windfall for me because effectively I'm going to risk, let's say 50 pips, right? So because I'm risking twice. I'm risking minus 25 on 2 lots. One lot I make 25 on, and the second lot, if I can make 75 on, I've now made 100 pips on 2 lots against a 50 pip risk. And even though I only make the 75 pips on the second position, maybe 3 out of 10 times, even if I can do that, overall, that creates a very positive structure. Or if I don't want to be that, what we call going for the fences. If I don't want to try to hit a home run all the time, what I can do is manage the second half of the position by using what we call a 2-bar high. Or a 20-period SMA. In other words, if let's say the price comes back up above 20-period SMA on a short or below 20-period SMA on a long, I am out of it. And remember, we're trading about 5-minute charts, so there's a 20-period SMA and a 5-minute chart. But here, I believe, we have an example of what we call a 2-bar high. And 2-bar high basically is where, remember, if you're selling something, the highs should be lower, 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 right? You have a series of lower highs. The moment you get a higher high, right, the trend is broken. That is the sell-off is broken. The buyers overwhelm the sellers, even if it's in a very, very short time frame. And, we tag ourselves out. Now, notice, by the way, that what's interesting about this example, this is kind of an interesting example, because here's this example where if you did go for the home run, if you really wanted to milk the hell out of this trade, and you went for 25 pips on your first trade, and then you try to go for 75 pips, you actually could have done it. But you would have had to endure a retrace that could have almost, stopped you out. So the point being is there's lots of different variations on how you can trade this. You have to do it what's comfortable for you and what you find best. But all of them are structured in such a way that they're very, very disciplined, very rules-based. Whatever you decide to do, you should stick to it and see how well it works out for you, to see what works out best for you. But all of them have an internal logic to them that I think is very sound. Paul is asking me, he says, I really like the proactive mode, but I'm wondering if other economists can't apply the same logic, because if so, the advantage is gone if I'm correct. Yes, you would think that a lot of economists would be able to apply this logic, but what's interesting about this is just how inefficient it can be sometimes. We find that there is a lot of mispricings of expectations, and I think part of it is because economists don't adjust their expectations as quickly as traders do. They run these big models. They tend to get polled once a month instead of once every single day. And so the expectations that you're seeing on Reuters or on Bloomberg can be a little bit laggard. And because of this lagging factor, they tend to be a little bit inaccurate. Yet this is, because this is the only reference points that the markets have, they tend to pivot off those reference points. Now, does this work all the time? By no means does it work all the time. But even if it works 55% to 45% of the time, it gives you an incredibly interesting edge if you can find it. And that's the critical thing about proactive trading. It's not about winning every single trade. It's just about winning the majority of the trades towards your goal by using this methodology. So let's go through another example of how everything is trading. Just watching the prices here today because we obviously have the ECB meeting. New Zealand retail sales, another good quality tier 1 event worth handicapping. And one of the interesting things about New Zealand and Australia is it tends to get followed less. Remember, there's less economists following those two countries, so you tend to have bigger discrepancies. Remember, the other thing that I talked about, is how small countries like New Zealand can have massive discrepancies in actual versus expectation numbers because just small movements in the underlying economic activity could skew the numbers hugely, right? So the market is looking for 1.4, previous is 0.4. Where are we going to look for our clues? Well, New Zealand prints credit card spending. It's a really interesting little report. Very few people follow it, but credit card spending is a really good precursor for retail sales because if you think about it, most of our retail spending is done on credit cards, right, in modern industrial world. So credit card spending, I believe, was up, right? It was stronger. So what we think is that we think that the retail sales are going to be stronger, and indeed the numbers are 2.1. They actually become much stronger. So we were going to get long the Kiwi dollar. So we get long Kiwi dollar 5 minutes ahead of time, right? And you see that one of the interesting things when you're trading these less liquid currencies is that the adjustment process is pretty quick. And as a matter of fact, if you're on the right side of it, it's really sweet because you basically get 30 points in 5 minutes. If you're on the wrong side of it, not so pleasant. But when you're on the right side of it, this is a really great move because everything gets adjusted. And remember, this move, you can't enjoy this move after the news is released because it's although the candles looks like this, the reality of life is that here's price, here's the news release, and here's the next price right over here, right? The market moves. So you have to anticipate it. That's the risk. The risk is you got to anticipate it, but that's also the reward because if you anticipate it correctly, the reward is that you get this next price, much better price than what you did. So that's proactive news trading. It's very interesting, but I warn you that it can be also very dangerous. So the first and foremost thing when you're thinking about proactive news trading is that you really need, especially when you're starting out, to trade on low leverage. There's a couple of examples I gave you of how you can trade it. You can fool around with it and tweak the strategies to your liking. You can change the take profits. You can change the stop orders. You can do all sorts of other things that may be more malleable to what you want to do. But what you shouldn't do, in my opinion, is trade any proactive news on more than 5 times lever. So if you have a $10,000 account, you shouldn't trade more than 50,000 unit position in front of news. This is my own personal opinion, my own personal editorial, but I believe that is advice that will serve you well because you will make a lot of mistakes. You certainly don't want to do something like get in front of a news event at 20 times lever, 10,000 account, 200,000 unit position, and then drop like 50 points in that position and basically lose 10% of your account in one single, in 1 minute. Just not that much fun. So reactive news trading. There's key things that we talked about in the reactive news trading. We've covered this earlier, but it's worthwhile to review it. There's 2 types of information, right? There is what we call scheduled data, which is the calendar, and we always look at that, of course, as our starting point. And the scheduled data is economic news releases, central bank meetings, which we have today, G7 and G20 meetings, treasury auctions, things that everybody is aware of. They're posted, they're publicly related stuff, or unscheduled data, which is political news events, commentary from central bankers, fiscal authorities, M&A and fixing activity. That's mergers and acquisition activity. That is a company deciding to buy another company and needing a huge amount of currency in order to do that. Or the everyday fixing demand, where prices get, the currency values gets fixed for portfolio purposes for bond and equity managers. And we don't know ahead of time, how much demand there is for certain currency depending on how much investment there is that day. Upgrades and downgrades from rating agencies which come out at any given time of the day. As a matter of fact, I think Spain was upgraded today to a more positive grade. And geopolitical events, anything that happens in the world that could impact trade. Remember, currencies are political as well as economic units, and therefore they're very sensitive to political change as well as economic change. So unscheduled data, in many ways, is the bane of our existence, right? Unscheduled data is what none of us can anticipate. Unscheduled data is what destroys a lot of our trades, but that is the fact of life. Unscheduled data is basically life, right? Life as it is versus life as we want it to be. But scheduled data is what we want to trade. So there's 3 different ways for us to trade scheduled data. And I'm going to go through the 3 methods of reactive trading. Now, reactive trading means that we're going to trade after the news. When the news has been released, we don't have to guess, we don't have to anticipate, we don't have to estimate what the news is. We're going to move afterwards. So first and foremost, the easiest and sort of the simplest way is what we call the wait the 5-minute rule, where we wait for the candle break. This reactive strategy does require a lot of swiftness. I mean, not so much. You still have 5 minutes. And the reason why we wait 5 minutes is because, first of all, in the first 60 to 90 seconds of any major news release, there is so much volatility, intra-volatility in the interbank market and in your own dealing platforms. The spreads go wide. Dealing gets really, really crazy. A lot of skews on the order books come in. And it's extremely difficult to, 1, get off a trade, 2, get off a trade at good prices, and 3, stay in the trade sometimes because you could literally have a move of 25 to 35 point moves in prices in 1 minute that could wipe out all your stock positions. So what we're really basically looking for in this 5-minute wait rule is technical confirmation on a 5-minute chart, right? So here's a Australian PMI manufacturing, right? Comes out around 49.6 against a 43.8, better than expected, right? What do you call it? Candle is nice and green, right? Big candle. Has a high over here of 91.42 or so. And what we want to do is we want the price to confirm to us that this is a buying opportunity. So what we're looking for is for the high of this to be broken, right, to the top side before we can come in and enter the trade. Now the rule number 2 of this is we're going to trade this with even money, 20-point stop, 20-point target. And here's the trade in its essence, right? Sorry, I'm just wanted to orient myself properly. So here's the 5-minute candle, right? It gets broken right about here. It takes about 20-30 minutes for it to, for us to get taken out. Now, what's interesting, by the way, and this is the reason why you need a 20-point stop, is that in a perfect world, everything just simply goes straight up, but it doesn't. Generally, you have always a battle between the buyers and the sellers. Nothing ever is easy for you in the marketplace, and you have to give yourself some breathing room to see if if the buyers can overwhelm the sellers. So here, they take it up to 45, but then the sellers come in and try to knock it back down. They knock it back down to about 30, but after that, they're done. There's no more selling, and then the second wave of buying comes in. And generally, this is how things work. You don't necessarily get the move on the first wave of buying, but why do you enter on the first wave? Because on those occasions when you do, if you hesitate and you wait, you miss the trade. The risk is there is no perfect solution to any trading that you do, right? You're always going to have to assume risk. The critical thing is to assume what I call defined risk, assumed risk that you can absorb, because unless you assume risk, you will never ever be able to capture the reward. There's no such thing as just coming in and getting reward without some punishment. So in this case, you have to endure a little bit of a drawdown, but then the price comes back and it does hit you, and you have a nice even money. So the point is that if you trade this, and it's a 55-45% setup, so 55% of the time it goes your way, 45% of the time it doesn't go your way, and it's a 20-20 trade, that's actually a great trade. That's actually a great setup. That's a much better spread and odds than a lot of casino games. It's a lot better than many business propositions in life. So that's the key to how you make this on a long-term success basis. Here's another example. U.S. GDP. Market looking for 2.4, and the print is actually horrid, right? 1.8. Now, as I said to you, remember, I talked about this in other sessions where we said that the GDP numbers for large countries like the United States really don't, I guess I'm just watching what's going on over here. Interesting. We have the ECB meeting right now, and it looks like Mario Draghi is kind of killing the euro. Anyways, what I was saying is that in large events like the GDP big miss like this, you will get very powerful movements. So here the yen adjusts very quickly, 90.70 to like 90.30, right? This is the 5-minute chart, right? And the break here is 97.44. 97.44 is the low, right? It trips the low. Again, here's the realistic signature of a trade, right? Everybody wants to tell you, enter here, and then it's easy sailing, and then you just exit over here, and you're done, right? In real life, and this is what I want to kind of really impress on you on all these strategies. In real life, you have to suffer. You have to suffer for your wins, right? You have to suffer for all of our sins. The point being is that you don't necessarily get the break and a continuation right away. You'll get a break. You get a break here, 97.44, and then you get lots and lots and lots of congestion as you have the big battle between the buyers and the sellers. And then you get that second wave, and here comes the second wave, and the second wave obviously pushes us even lower, and this is where we get the target of 24. Why does this happen? For a lot of different reasons. Because remember, the first thing that I talked about, and I think this is a great time for us to to sort of explain this. Who is on the opposite side of this trade? Who is buying while everybody else is selling? The interbank dealers, the Citibanks, the Barclays, the Deutsche Banks, the Goldman Sachs of this world. They're all buying the yen because their customers are selling. Somebody has to be providing a market, right? So they're providing a market, and they're buying everything around the 44s, right? So they're not interested. Their job is not to position themselves on the yen. Their job is not to forecast U.S. Monetary policy. Their job is to move inventory and make money on inventory as quickly as possible. So if they got a lot of inventory in the 44s, right, because they absorbed all of this crap from their customers, the first thing they want to do is move the inventory back out the door at a small markup. Just get rid of what's on the shelves. And what you see very often, of course, is after we have the initial price adjustment, right, the dealers will try to push the prices back up so they can move the inventory, so they can spend 10, 15, 20 minutes distributing this crap back off the desks. Then they lay off, right, and then you have more macro players, more market participants come in and say, you know what, this is really kind of bad news. I don't think the Fed is going to do anything for a long time. I'm going to sell the yen again. And this time, after the dealers have cleared their inventory, they're more than happy to drop their bids, and you have the second wave of coming in. So that is why. The news was not from Draghi, but for good news from the U.S. Okay, thank you, Sonny. Thanks for commentary, because I have specifically turned off all of my news flow as I'm doing this presentation, so I'm kind of trading blind. Anyways, my point being is that this is the typical signature dynamic of how news trading is done in a post-news environment. You get a reaction, you get a counter reaction, you get a secondary wave, and that is why you see this this 5-minute trade here kind of stall out a lot of times before it actually starts to move your way, right? And here you get a perfect example of where something doesn't quite work. This is Australian dollar. I don't know what event this was on, but I forget what the event was here. So here's moves news down. You trip the 5-minute 5-minute bar. Does not quite hit your target. Just doesn't quite make down to your target. And then the buyers come in and they sweep it back out and they take it out. And this, by the way, remember this chart, because we're going to talk about this just in a few minutes with respect to our other setups. So variation. We wait for the for the news candle break. We wait for the 5-minute candle to close, right? And then we wait for the break of the high or the low of the 5-minute candle, right? So same idea, but we wait for the we don't follow. So if the news was good, we're usually looking for a confirmation of a buy, right? In this case, we don't care whether it's going to be a buy or a sell. We just look to see if the 5-minute reaction candle gets taken out to the upside or to the downside, and then we're gonna trade that particular box, right? So here's the same event, 49.6. No, sorry, it's different. It's same release, PMI manufacturing, but 49.6 against 43.8, right? We're buyer here. On the news candle, and we're buying 91.50. This is the news candle. We're buying the high of the news candle, right? Because in this case, we're actually looking to either buy the high or sell the low. The high gets tripped. We buy the high, and the target here is 90.70. That's done, right? Here's the news candle where this is the 5-minute news candle, and this is kind of interesting. We're looking to buy the high or sell the low. In this case, dollar CAD drops and then it pops back up, right? It pops back up and it actually takes out the high of the 5-minute candle. We buy that and it moves up, and we make the trade this way. So here's CAD employment. This is one of the reasons why, by the way, I despise trading the Canadian dollar. In one of the currencies that I think this works worst in, and actually this is a good time for me to stop and sort of talk about where I think these kind of strategies, where the reactive strategies work best in. In my opinion, having tested a lot of this stuff, both live and back tested, reactive strategies work the best on the euro dollar, second best on, and really it's a toss-up. It's not like it's a 1, 2, 3. It's really 1, 2, 2. Best on euro dollar, and second best on the pound dollar and the Australian dollar, right? And then they work much worse on the Canadian dollar. They work relatively fair to middling on the New Zealand dollar, and sometimes they work on the dollar yen. But really, if you want to focus on reactive strategies, what I recommend is there are only 3 real currencies you want to trade on a reactive strategy basis, which is the pound, the Australian dollar, the euro dollar. And of course, for the euro dollar, you can trade both the European news and the U.S. news, right? So that's why I think it's worthwhile focusing just on those. The Canadian dollar is a perfect example of why I hate this pair. So here's the 5-minute candle. Canadian employment really, really bad. The dollar CAD really goes up. Then it ticks up just a little bit more to take you into a trade, and then comes right back down and stops you out. This is notorious behavior of the Canadian dollar. We talked about the fact how I feel the Canadian dollar is manipulated by the 4 Canadian banks. And this is, again, this all goes back to my my description of dealer-based markets. What's going on over here, right? We have bad news for the Canadian dollar. Everybody wants to buy the U.S. dollar, sell the Canadian dollar. All the customers do that. Who are the sellers of dollar CAD? The dealers in Canada, right? The banks that make the markets in dollar CAD. So they're all selling this while customers are buying. What's their number one objective? To get rid of inventory. They've sold it 105.60, 105.70, 105.80. They want to bring this thing back down. They got short at all these prices. They want to bring it back down so they can take their inventory back. That's exactly what they do. They take the currency back down over a period of 2 or 3 hours, and they got rid of all their inventories, and the customers are basically stuck holding the bag. Welcome to trading Canadian style. There's a request from Melanie for me to repeat what I consider to be the most tradable reactive currencies. And those currencies, number 1, the euro dollar, number 2 and number 3, the Australian dollar and the Great British pound, and then the New Zealand dollar is a number 4 candidate, not as strong. The worst trades to trade on a reactive basis, the Swiss franc, the Canadian dollar, and the dollar yen is not it's not as good a trade in my opinion as the euro dollar. That's why I don't trade the dollar yen, but it can be traded. Any more questions on this, by the way, on sort of the reactive dynamic trade and how to deal with trade? So Paul is asking me which ones do I prefer for pro-reactive. I mean for proactive. Paul is asking me which ones do I prefer for proactive. The order is the exact same. The same currencies that trade well reactively trade well proactively. Although when you're trading proactively, it's not nearly as a stricter rule set, right? Because proactively, if you're correct, things are going to move. If you were correct on guessing the Canadian data was going to be weak, you were going to be able to, you're going to be able to bank the pips here because it still moves. So proactively, it's not nearly as strict a selective process. Where the skill lies in proactive is not in selecting the currency, but in selecting the right event and, in, of course, handicapping the event properly. That's really the skill set that matters the most. The currency itself is much more of a secondary condition. Whereas in the reactive trading, where you're not selecting, you don't have to figure out what the event is going to do. The real skill set is twofold: selecting the event itself, what do you think is going to be a movable event, and number 2, selecting the currency against that event that will have the greatest continuation. So I'm going to now come to the end of our presentation by showing you the final strategy that we trade, and this is the strategy that I trade myself, strategy that I prefer. And this is a strategy that we will be utilizing in our NFP trading tomorrow. So I'll be going through that on my live trading strategy, but here, for our education purposes, we're going to go through this relatively slowly and carefully so you understand. So we call it, you can call this identify the time box. There's a million different ways we call it. We call this the Costanza trade because of the reference to George Costanza out of the Seinfeld fame. You'll understand why in just a second. But the bottom line is, what we're trying to do here when we handicap an event is we try to find what we call the event price zone. And the event price zone, that is, what were the prices like just before the news release, and what were the prices like after the news release that reflected most of the information the news release produced. we believe that the optimal time frame for this is 20 minutes, right? 5 minutes before, 15 minutes after, that's the optimal time frame for these news events. So here's an example of industrial production, U.S., 9:15 trade. What we try and do is handicap the orders on 20-minute basis against this box, both at the high and the low of that particular time range. So we have a 20-minute time range, and we ask ourselves, what is the high of that time range, and what is the low of that time range? And instead of trying to figure out whether the news was good or the news was bad, what we want to try to figure out is what is the reaction of the market going to be to that news? In other words, will the market decide that, yes, the news is indeed good and it's worth continuation? Or will the market decide, yeah, whatever the news was, it's not nearly as important as something else that I'm thinking about, and therefore it requires rejection. So because we don't try to handicap both the price or direction of it, we're agnostic. So here we create the box, which is a 15-minute box, and we have a sell at 98.62 and a buy at 98.77. This is a dollar-yen handicap, right, against the U.S. industrial production. And basically, if the highs get taken out, we cancel the sell order. If the lows get taken out, we cancel the buy order. It's one cancels the other order, and we just simply manage, the second order. Now, there's a lot of different variations on this theme. You use a 25. Generally, I always use a 25 pip stop because that's the minimum you really need in order to give yourself some breathing room. And there's it all depends on how accurate and precise you want to be. You could try to use a 15 to 25 pip first target. Generally, it's very difficult to achieve that kind of a first target off of what I call minor news events, and sometimes it's very difficult to achieve that first target off of major news events. So the target itself is a function of just how high an accuracy ratio you want. The example that I'll show you tomorrow is a very, we try to go for a very high accuracy ratio, and it has a very, very small target. But as a result, obviously, you have to be very accurate tremendous amount of times in order for this setup to work. But if you're working on a setup like this, where let's say you're using a 25 pip target, 25 pip stop, you don't only have to be correct, again, 55 to 45% of the time in order to be able to take advantage of the trade. And here, good example, the highs get taken out, and actually the trade gets run much higher, and you're able to take advantage of this move towards the 25 pip move, right? So again, just to review, we have the highs and the lows. If one gets triggered, the other gets canceled, and we can trade it with a variety of various stops and targets. In this particular example, I used a 15-point target against a 25 pip stop, or a 25 pip target against a 25 pip stop, which is a lower accuracy setup, but it obviously doesn't require nearly as a high an accuracy rating in order to make it go. What's very cool about this setup, and what you will see tomorrow, especially, this is a setup that I love to trade against what we call hyper volatility events. Hyper volatility events are exactly the kind of things that we do not trade proactively. So central bank meetings, like today, for example, we'll be trading this against the ECB meeting. NFPs, which of course we're going to be trading tomorrow. IPO, which is a very big moving event. PMI services out of Eurozone is a big moving event. These are events that tend to have sometimes 50 to 75 to 100 pip continuation moves, one way or the other, against the event. These hypervolatility events lend themselves best to this kind of a setup. And remember, the setup is direction agnostic. It does not try to forecast direction. It simply lets the market absorb the news and then tell you which way it thinks the direction should go. And that is how it trades out. So I hope that that clarifies a lot of things for you. And you can basically see that if you have 2 pieces of tradable data per day, 5 days a week, you have 10 trades per week, 40 trades per month. You got to be, if you're trading this kind of an event, you really need 30 trades right to break even. You got to be about 75% accurate to break even. What I recommend, and what I think is a much wiser selection here, is trade less, because if you want to have a high accuracy rating, you actually have to trade less. You have to choose the most continuous events and trade those. And I've actually, when we initially started this, we started with around 20 events, and now we're pretty much down to about 10 events a week, 10 events a month that we want to trade. in terms of movement. So here's a Australian employment, right? And you have an example of a high-low box, 15-minute box, right? The low gets triggered over here, and the low, the target gets made over here. This actually is another very interesting signature of these reactive events. When you have a major piece of news, so you have big move down, sort of a small reaction here. In this particular case, for example, the dealers really can't lift it back up. So all they're trying to do is get their inventory out as much as possible to break even to small losses. So here, they bought everything down. They've taken about 15-20 minutes to kind of get rid of whatever inventory they have. And then after that, since there's very little buyers, right? The natural pressure, the essence of this event, which is a bad event, starts to weigh on the market, and it starts to drift lower as more and more people begin to sell. And so you're taken into the trade and let the trade work its magic all the way down to its move. Here's U.S. retail sales. This is an interesting example of why we trade both sides. So the U.S. retail sales initially is good news. It creates lots and lots of positive volatility to the upside, and this is a very good example of why we wait 15 minutes, because pretty much everything that's baked into the event, pretty much, not always, but pretty much, is done by the 15 minutes window. So after 15 minutes, everybody has absorbed the news. And then the question after that is, okay, do we want to continue this positive momentum off of the news, or is there something else that we're going to focus on? And when there's something else that we're going to focus on, what's very, very interesting about this particular event or this particular trade is because everybody has positive expectations. When price goes negative, right, everybody who bought here is completely caught surprised. And so they are stopped out of their positions, and it creates a cascade effect. So very often, the opposite of news, what we call the Costanza trade, that is, the reason why it's called the Costanza trade is because it comes from the Seinfeld episode where he decides to do the opposite of common sense. Where the opposite of common sense, where the news is positive but the price is negative, tends to be a very powerful move, and taking advantage of the price against the news tends to be a really good high accuracy trade. That's why we're agnostic. We don't position in this particular variation of the trade. We don't position ourselves with the event. We position ourselves with whatever the price tells us to do. And here, occasionally you will get these kind of situations. So UK employment, big move up, right? The high is very, very high. It starts to drift lower. It drift lower, kind of trips just the bottom of this candle, right? And then doesn't quite extend. This happens. If this setup worked all the time, then we wouldn't have to talk about anything else. And you get stopped out. This is the classic signature of a failed box trade, where you do get the trip. And in this case, for example, it's the opposite trip. It's the opposite of UK employment, but doesn't quite have any follow-through. Basically, this is profit-taking, but not enough to press things to the lower side, and fresh buying comes in, and you're stopped out of the event, right? So what to trade when? If you're trading in the morning in Asia, right, this is Asian time, you'd be trading Australian, New Zealand, and Chinese data. In the New York time, this is PM time, 6 p.m. to 10 p.m. New York time, you'd be trading Australian data. If you're trading in the afternoon for Asia, or very early morning in New York, or basically morning in Europe, then you trade the euro and the pound data. And then everything can get traded during the U.S. Data session. Although if you're trading this particular box setup, my preference is that you'd be very selective and trade primarily UK, Australia, European, and U.S. data for the box setup. So that's our seminar for today. I'm going to open up the floor for questions. There's a couple of questions here, so let me just address them. Senny is asking me, in the central bank comments, like Draghi today, did we start the time enter to the trade after he finishes talking, or we just use the 20-minute window when he starts talking? No. Well, central bank trades have their own dynamic. And this is all right. I'm going to ignore this call. That's Reuters on the phone. Okay. Sorry, guys. Central bank especially ECB data, is what we handicap is about 45 minutes. That's the only difference is that this is the one event where we don't do 20-minute absorption because he talks for about half an hour. He starts 8:30. He's going to talk till about 9, 9:10, 9:15, and that's pretty much what we do. With ECB, we don't really put on the trade till 9:15. But with other events, it's just 20 minutes. Melanie is asking me what is the difference between the first example where we take the 5-minute break and the 5-minute candle and the second example. In the first example, we take the if the news is positive, we're only taking the 5-minute candle high. If the news is negative, we only take the 5-minute candle low. In the second example, we just simply take the break of the high or the low after 5 minutes. If you think about this, the difference between the second example is that we're using a much shorter duration to base our the highs and lows on. The second and third example, which we call the box, uses a 20-minute window for highs and lows. The second example basically uses a 5-minute window for highs and lows. Arvin is asking me how you decide the buying and selling for the news. Arvin, you're going to have to watch this on video on demand because I went through this at the beginning of the webinar. So take a look at when I post this on demand. You'll be able to see it, no problem. Paul is asking me what is the success of the calendar calls for the 2-3 years used? Is it about a 60% rate of success? Is it possible to have a 60% rate of success? I believe it is possible. Kathy has the numbers. She may be the better one. You may want to email her and ask her what the accuracy rate of her calls is, but it's definitely a positive edge. So I would say conservatively between 55 to 60%. That's been her edge on those calls. But again, remember she's only calling a beat. So her view isn't she's basically saying is it going to beat or miss the estimate? That's really how she's gauging her accuracy. John is asking me that on the first strategy, the stop, one of the stop variants is to use a 20-period SMA. Is that on the 5-minute chart? Yes, it is on the 5-minute chart. Yes, exactly. Exactly. No problem. Okay, guys, I got to run. We have to wrap up the session because we have now the BK webinar. Tonight, Kathy is going to repeat this webinar. I recommend for those of you who have the time, you may want to take a look at it with her because we have sort of a little bit of different variations on the theme of this particular webinar, and I think you might find it very interesting. And then more importantly, I will, of course, join you on Tuesday for the final webinar, which is the Money Management Secrets webinar, which I think you'll find it very, very interesting. And I hope you guys will spend some time on this. Ursula, we send all the emails out. I think we have your email. We send after every single webinar, we send an email with the links to where all of this is posted. If you're not getting it, just simply email us at contact@bkforex.com, and we'll send you the link. But everybody should get it. You're saying you're not getting it. I think you're not getting it because it may be going into your spam box. So check your spam box. If you're not getting this, it's because it's going into your spam box or it's going into your promotion box in Gmail. Look very carefully. Yes, it's the days of modern email. Okay, guys, I thank you so much for this webinar. I hope you guys found it interesting and entertaining. And of course, we're going to put this into practice tomorrow for the live NFPs, and I hope to see you there. Thanks again, and I'll see you next week for the final session. Take care.